Welcome back to the channel. My name is Brad, and today we're going to talk about SCHD and TVDI. Somebody recommended TDVI, said, hey, it's beating SCHD in total returns. I had somebody say, if it's all about total returns, Brad, you don't need to income invest. Just invest in SCHD. And I'm sitting there going, really? That's interesting news that somebody's giving me financial advice, telling me, you don't need to do this. You don't know what you're talking about, Brad. Huh, okay. I'm scared now. Maybe this person was 100% right. Maybe I don't need to income invest and I can just put my money in SCHD and wow, that would simplify my life and I wouldn't have anything to worry about. And uh-oh. Maybe I've been wrong this whole entire time. So let's talk about it. SCHD, if I go back to the original day that they started, they're up 420%. Brad, you could just take your 8% and get on down the road. You got all this gain. What are you worried about? Why even think about this? S&P's up 382%. Again, Brad, why? It's up. This is from 2011. You don't need to do all this income investing. Just put it in SCHD and the S&P 500 and you'll be just fine. Well, that's a good thought. Maybe I should. Maybe I should take financial advice from somebody on the comment section. Maybe I should. So, hey, TDVI, it's been around for about a year or so, and it's up 40.54 compared to SCHD of 23.74. And the S&P 500 is up 40%. So I'm sitting there going, okay, maybe these guys, maybe all of these guys have something that I don't know about. Maybe I'm missing something. Maybe I am. Or maybe they're missing something. Maybe they don't understand what I'm trying to do. So let's talk about basic concepts here. It's called sequence of return risk. I've talked about it in the past. Obviously, this is just going right over everybody's head. So we're going to just run a couple examples and give you some feeling about why Brad is focused on total return minus 8, but he's also focused on that percentage that he's getting, he's also focused on that percentage that he's getting so he doesn't have to sell shares, because that's important. Brad, you're full of it. Well, the S&P 500, if I go back and I look at annual returns, and this is from like 1928, not something new, kind of old. It's been around for a while. I look at those annual returns, man, I see annual returns above 40%. Brad, you could just take your 8% and you're good to go for the rest of your life. All right, I'm glad you really feel that way. Well, SCHD hasn't been around long enough for anybody to have real good data. But the S&P 500 has. If you retired in the year 2000 and you took out your 8%, you were back to work in 2010 and you had a JOB. You just ran out of money. That's the way it worked. Your original investment was $50,000 minus $5,000. You withdrew your 8%, which was $4,000. So now you're down to $40,000. And it just gets worse and worse every year. And then when you have a good year, you were already down to $20,000. So you didn't have too much to go for. And that $4,000 withdrawal just continued to nag on you every year because you just didn't make enough money to cover that $4,000 withdrawal from your $50,000 investment. So you had to go back and work in 10 years. That's a really good plan for those SCHD people and people giving me advice of, you don't need to do this, and you can just invest in SCHD and S&P 500, and you'd be good to go. Well, that doesn't look so good to me. If you retired in 2000, that's bad advice, people. Bad advice to give Brad. Maybe if I just went ahead and retired in 2003, just worked those couple more years for the market to recover, where am I at today? Well, you had some really good years, 2003, 2004. Uh-oh. 2008 came. Uh-oh. You're not doing so good. Your retirement now, taking out 8% is down to $38,000, but this is really good because that's 21 years later, but you didn't give yourself a pay increase this whole entire time. You're just not making it. So, I don't know. That doesn't seem to be a really good plan either, because you're failing. You're failing pretty hard. I don't know why these growth investors think that you can just take 8%. I mean, Dave Ramsey says you can take 8%. The math doesn't pan out. If you retire in the wrong year, it doesn't pan out. So continue to go down that road of growth investing and not worry about your returns on your capital and income, because somebody's got to be serving me that Starbucks when I go, because I don't have a job. They're on the other side. I'll wave to you as you're working at Starbucks. Or, you know, those guys at Home Depot that have to go back to work. Thanks for helping me load the lumber into my vehicle so I can go do something and not have that job. If I look at more recent times, and I'm going to just go look at really more recent times. You retired in 2022. Going into 2025, you're just breaking, you're not even breaking even. Just saying, you're at $48,000, taking your 4%, because you started with 50, you had to take out $13,000 in withdrawal, even though 2023 was a strong year for you. Good to go for the S&P 500. You're not making ends meet, and you have a risk of running out of money. That is why I income invest. I think people are missing the whole point. You cannot invest in the S&P 500 or SCHD and pull out your 8% and think that you're going to get away from sequence of returns. It does not work that way. Sorry. I don't know what else to tell these SCHD people. And invest in Coca-Cola. Okay, you're going to run out of money. I just don't. Just thought I'd throw it out. Just thought I'd throw it out. That's why you income invest. That's why you do income investing. Something that's giving you 13, 14% on your money. Now, the market goes down. Yes, that's very true. The market goes down. And I'm going to throw out SPY. Right now, the market goes down 5%. Guess what? My SPY is still above my original cost, and I'm pulling out my 12%. Same thing with QQQI. I'm up enough that I can take a 5% drawdown, and I'm still above my cost basis. And that's not even reinvesting. So you got to sit back and look at this in different light and different mindset. So let's talk about TDVI. This is actually a technology, dividend income. It's not quite the more protective SCHD. So you sit back and go, I don't know about this. It gets you about 8%. Okay, it's not, it sells options on the index, either S&P 500 or the NASDAQ index. It's only giving me my 8%. It's barely getting that 8%. So you're going to have to sell shares. I do not want to sell shares to retire. Selling shares is not what I want to do. It's not. If you're selling shares, you're not getting there. And that's just the way that it is. If you're selling shares, you're not going to be able to do that. But I back tested it anyway. If I took it from the original time for SCHD, you can see if I took $1,000, and that's because they paid on a quarterly basis. So it's normally $333.33. But since it's only on quarterly, you just don't have that. If I did my original investment and I put everything back in, you're above board. If I took out my $1,000 and my $1,000 came from the red line, the 100%. So I had to reduce the red line down $1,000 per quarter, and I get the green line. If I reinvested $0 back into SCHD and I didn't take any distributions, so SCHD, you're taking capital gains, you're taking appreciation of your NAV and reducing it. Well, you're still doing pretty good if you didn't have to reinvest. It's up a little bit. I look at this saying, hey, that's not bad. But you're having to sell shares to make it. You go into a bad year and you have a JOB sometime in your life again. And that is not what Brad wants to do. I looked at TDVI, same issue. Yes, it's beating SCHD, but I had to sell shares and I am stomping my feet. If you have to sell shares to get you your percentage, you are going to have a problem in life. What you should be able to be doing is taking your 8% and not have to sell shares. If you're selling shares, your share count is going down. Sorry, eventually sometime in your life, you probably will have to go back at a job. I just don't know what else to tell you. So don't sell shares in retirement. SPY, I don't have to sell any shares. I do just fine. QQQQI, I don't have to sell any shares. I can do just fine from the revenue that they give me. In a downturn, revenue is going to go down. Okay? 100%. You're going to make less when it goes down. You have to understand that. But they're paying me 12%. Let's do some arithmetic, people. Let's do some arithmetic. So, some quick arithmetic. This is just some math off the top of your head. If you're making 12% on your money, like a SPY, we're just going to beat them up for a little bit, and the market goes down 20%, a 20% downturn, you're only going to really be making 9.6%, not your 12% on your original capital. That's just some quick math. So you got to sit back and go, this is why Brad invests in certain ETFs. He's investing so he can withdraw his 8% and not have to sell shares. Sorry, all these people that think that you can do this off of Coca-Cola and they go back and they do this yield on cost, you're going to fail in retirement. That's not income investing. And by the way, you want to grow your pot as big as you can before you start income investing. Can you use income investing while you're growing? Sure. If I threw out some general rules of it should be 90% growth in your 20s, 10% income. You get in your 30s, you might want to jump that up to 75% growth, maybe 80% growth, 20% income. And as you get closer and closer to retirement, it should become a bigger and bigger proportion of your nest egg. In your 20s or 30s, you do not need to be chasing. Somebody asked me the other day, and this is a good one. I'm just going to go ahead and throw it. What is the best fund? And he commented on a Misty video. What is the best fund for somebody in their 30s? And I just shake my head. Go ahead and invest in Misty. You 3x your money. Or you could invest it in MSTR at the same exact time and 6x your money. Income investing caps the upside. No question about it. So you want to grow your nest egg as big as possible. Now, am I going to tell him to put all of his money into MSTR? No. You can if you want. But no. Put your money into Misty? No, not 100%. I don't know what these younger people are thinking. They're trying to get rich quick, and that is scary. Do not think that you're going to get Brad to tell you to put all your money. I did one on AI stocks. Yeah, 5-10%, especially if you're young, trying to build that pot. Putting all your money in there? No, not at all. And all these examples are showing 100% equity investments. These did not take into any bonds. Brad doesn't own any bonds. Brad owns business development companies, preferred stocks. I guess I do have a little high yield bonds, but okay. CLOs and alternatives like SVOL, where I can take my 8% and reinvest my 7 back into it, and I will be just happy forever and ever and ever. While you invest in SCHD and think that you can sell shares and have a JOB in 10 years, maybe 15. If you're lucky and you retire at the right year, maybe you never have to go back to work. But that's not the risk and sequence of returns that I want. So hey, that's today's video. Hopefully you got something out of this. I wasn't going to go ahead and review SCHD. I just wanted to show why you need to be careful on investing and having to sell shares. TDVI seems to be a pretty good fund. If you're pulling 7%, awesome. You're pulling 8%, it's okay. You're pulling 10%, you're probably having a risk. If you're trying to grow your investments, great. But once you get into retirement, you need to look at the income and not have to be selling shares later in life. Not what Brad wants to be doing. Until next time, God bless.